have a fantastic panel here. We have what we're calling the inside view, which is from AB InBev and from USS Superannuation. And we're having what we're going to call the external view. We have McKinsey and we have Moody's. So let's get started immediately. My name is Danny Ralph. I'm the Academic Director of the Cambridge Centre for Risk Studies. So what I'd like to do is ask each of our panelists to introduce themselves via a particular question. And I'm going to start with Anna Moore from McKinsey. Anna, what is the link between ESG and financial value creation?
Thanks so much for the question, Danny, and fabulous to be with you and with this panel this morning. It's an enormous topic. I'm going to give you a few thoughts, and then I'm sure we're going to get into it over the course of the conversation. I think first point is there's no sustainable value creation without social license. And that's not a new thing. You can think about sweatshops and shoes in the 90s, but I do think, and we see in our research, mounting awareness of and observation of externalities. You can think about the pressure on companies around GHG emissions, but also things like job creation, their impact on local communities, et cetera. It's also increasingly a prerequisite, of course, for capital attraction. We had about $5 billion of inflows to sustainable funds in 2018. We had $70 billion in 2021. And in the first half of this year, we had $130 billion in net new money going into these funds. So long and short of it is you have to do this. But for us, what actually gives us a cause for optimism around ESG is that it's not merely value preservation, but also value creation. We see $9 to $12 trillion in new sustainable value pools by 2030. And that's a mixture of serving new end markets, renewables, electrification, et cetera, but also businesses that will facilitate a just energy transition. So that's responsible sourcing, tracking technologies, carbon management software, which we think could be worth up to $200 billion alone, things like this. And we're seeing companies create that value through portfolio strategy. Think of Atlas Copco pivoting to serving renewables instead of oil and gas. Through market share and green premia, we expect about a 60% gap between supply and demand for green steel, which will create real premiums within that market and facilitate true investment. Also new business building, think of Northvolt, Polestar, companies like this. And finally, through operations and supply chain, value from responsible sourcing, things like this. That's what gives us cause for optimism and is the true source of value creation from ESG. Thanks.
Okay, thanks, Anna. Very comprehensive. And so, Lindsay, Chief Risk Officer of USS, how do you see the investing community in general, and specifically asset owners, approaching integration of ESG risk issues?
Sure. Well, thank you. And great to see everyone. And it's great to be back in these events in person. In terms of the investing community, I think ESG teams in asset managers have become much more integrated over the last few years. So if you look, USS, we're both an asset owner as the trustee of a pension scheme, but we also have our own asset manager, and I look after risk for both. If you look at our asset management business, we've had a responsible investment team for 20 years. Probably early in that period, focus was on governance and engagement, stewardship, early interaction with looking at climate change and IIGCC. But then those teams have grown, and as you look across the asset management industry, those teams have grown, and you're seeing them becoming more integrated into the investment process. So moving from being sort of a separate team, building up the resource, building up the expertise, building up the knowledge, to now really transferring that so it becomes part and parcel of the sort of investment process. So in a way, I expect the idea of ESG investing to go away and for it simply to become investing. It's part of the investor's toolkit. As well as my role at USS, I'm on the board of the CFA UK, which is the Chartered Financial Analysts Society, and we're seeing there huge demand for qualifications for people who've studied, how to value companies, how to construct investment portfolios, and they are taking certificates in ESG investing or certificates in climate and investing, and really building up the toolkit of knowledge that they need to be able to invest looking forward. I think I agree with everything Anna said, and I think that we are in the investing community in general, we're really integrating ESG, and I think for us as an asset owner specifically, we have a much longer term view than many of the asset managers, and I think for us, the way a company is run and overseen, its culture, its management ethos, how it manages its environmental and social risks, will definitely impact those longer term financial returns. So we're sort of seeing it as the same lens in a way, and it's integrated fully.
Great. Well, we'll be able to explore the investor side a little bit more, I'm sure. Thank you, Lindsay. And now we turn to Ezgi Barcenas, Chief Sustainability Officer of AB InBev. And Ezgi, we'd like you to put your position, as it were, by answering the following question. How is AB InBev approaching ESG? Do you see this as a differentiating approach, or are you sort of in concert with your peers and others? And indeed, how does this resonate with your investors?
Yeah, thank you for the question, and thanks for having me here today. Really great to be back in person together. So at AB InBev, as the world's leading brewer, we've got operations across nearly 50 countries around the world. And for us, the way we think about this is that this is not just about a sustainability strategy, but a business strategy that is more sustainable. And if you really think of it that way, then you put aside the siloed approach and you try to integrate everything you do into your core business strategy. So for us, it's pretty simple, really. The point of entry, first and foremost, I would say, is supply security. So how you think of your raw materials, such as barley, hops, how you think of your growing water stress, your packaging materials, the evolving regulatory landscapes around the world, the energy that you source to brew, package, transport, cool your products. So supply security first and foremost. Secondly, it is also about innovation, how we think about the future of agriculture, the future of packaging, the future of logistics. These are some of the questions that we try to tackle when we build a business strategy that is more sustainable. And thirdly, we do see a rise in conscious consumerism, right? Consumers are becoming increasingly more environmentally aware, socially aware, and for us, it is really important to continue to not demonstrate sustainability at the corporate level, but also at the brand level in a way that we can communicate to the consumer in a very authentic way. So not about a sustainability strategy, but about a business strategy that is more sustainable. And I think, many companies have gone through transitions when they think of their broader ESG agenda. First you start looking inside your four walls, then you expand that into your supply chain. Maybe, first you start upstream, then you start looking downstream as well. And for us, that's from that smallholder farmer all the way to a small retailer, a mom and pop shop. We've got about 6 million of them around the world that sell our products. So how you think of that entire value chain and the sustainability of it is incredibly important. So that for us is the way that we measure it. And I think the biggest turning point for us in how we thought about ESG was, I would say, last year when we had a CEO transition and our new CEO, Michel Decaires, came over and we built a 10-year plan. And alongside that, we also built or refreshed our ESG strategy to enable that 10-year plan, that commercial vision. Now you're starting to integrate it truly into a forward-looking agenda that will enable that growth, that commercial plan. What does that mean? If you expect your growth to come from, X% of your growth to come from markets across Africa, I'm making it up. What does that mean in terms of growing water stress, the widening yield gaps you see on the ground? How do you lift consumers out of poverty to fold them into your consumer base? So all these things, now you're starting to ask not only questions around what are the topics that are material to your business today, but also in the future as well, and how do you create and design that future? So, and yeah, from an investor point of view, that was really well received when we launched that forward-looking strategy back in December, because now for the first time, investors could really understand, okay, this is truly linked into the business strategy.
Okay, well, that's refreshing to hear, especially the end-to-end nature of your considerations and the 10-year plan. And we will dig deeper. So the fourth and final introduction by way of a question, Jimmy Greer, Vice President of ESG Outreach and Research at Moody's ESG Solutions. And question to you, Jimmy. To what extent do the proposed standards, sorry, I'm going to scratch, we'll come to standards later, let me move back. As a data provider, how does your approach to ESG assessment identify siloed thinking?
Yeah, thanks very much. I think it was so interesting to hear from the others about approaches and hear about that business model, that end-to-end view. And I think what I thought would be helpful to think about, well, how do we identify that siloed thinking? And I was thinking beforehand, like, what is the antonym of siloed? Is it for our purposes integrated, or is it actually something different? We think about something more complete, kind of total, or I don't know. Those is the sort of antonym of siloed exactly what we're looking for? And anyway, that's a little thing that was going around my head. And I was thinking from our point of view as a data provider and as an ESG assessment provider, heard about sort of the importance of governance. Governance for ESG as being kind of central to how we would assess that the right strategies are in place, the right internal controls are in place, exec level responsibility. So going much further than how many times the board meets. Those kind of very sort of straight vanilla questions as being a sort of a starting point. But I think for us as well, taking it to another level, when we are creating our assessment across different ESG criteria, we're looking at kind of broadly speaking commitments, the three areas, which are commitments, the sort of processes and the performance. And for us, you can see gaps when you see very strong commitments, kind of, they might be time-bound, they might be the kind of exhaustiveness of the commitments are really important. But then on the processes, on that sort of implementation side, kind of a gap. So strong commitments, a bit of a gap. And, for some areas, for some topic areas, things like biodiversity, for example, that's to some extent to be expected, although we'd expect sectors that are kind of more exposed to biodiversity risks and impacts to be further ahead. We see that gap. And, it makes you think about, well, what's happening in the external environment? We've got a framework for biodiversity disclosures, TNFD, being baked at the moment. That will probably close that gap. So some of these things are to be expected. But then if you're kind of going down another level, we might see that health and safety being really well advanced, very mature kind of part of an organization. Environmental practices, less so. And so we might say, well, actually, it kind of comes back to that governance question, comes back to that business model and thinking, well, why is it that those things are operating so distinctly in terms of overall performance? And that's sort of the kind of things we're doing and the kind of things we're trying to look at in the research that I'm involved in on a day-to-day.
Fantastic, and we're definitely going to come back to that because data is a key challenge, issue, and promise. Well, thank you all for joining. Just to let the audience know, we've got 5 or 6 topics. We may not get to all of them. I'll pre-announce 2 or 3 of them, and then we might have to cherry-pick some of the rest. So we'll be returning to the idea of silo busting. We'll be also looking at how international organizations manage. And we'll be touching briefly, if we can, on things like just transition and so on. But we'd also very much like to hear from our 2 inside views on how they manage the transition of their own organizations. Mm-hmm. And undoubtedly, it will make use of the information skills and the broad views of our external panelists. Okay, so I'm going to pose a question really to Eske and Lindsay first, and we'll invite Anna and Jimmy to comment. But we're interested to hear a little bit more about, and perhaps Eske, if you can go first, where has prioritizing and focusing your ESG efforts involved silo busting?
Yeah, I mean, just like Jimmy mentioned, I do think of ESG as a governance function, or sustainability as a governance function, right? So everyone thinks of ESG and governance being just the G bit. It's wrong. It's the entire thing, how you govern, how you think of these topics, and how you actually build org designs accordingly to deliver against your shared goals is really important. So for us, whether we look internally or externally, collaboration is very, very key. And I think it's fair to say I'm very fortunate that I work for a company at AB InBev. We're a very target-driven organization. And what that means is that you get assigned personal targets every year linked to your compensation, your variable compensation, that are then multiplied with company performance, and you get your bonus payout. And for years, we've shared sustainability targets across functions. So this is not just one team's effort. It's not just a sustainability team, my team of 10, 15 people of specialists that carry these targets. It's actually, it starts at the highest level of the organization. So multiple C-suite members, CFO, myself, several others that carry these targets, all the way down to, imagine an energy and fluids director in a brewery, an agronomist, a packaging innovation specialist, or a controller, or a corporate affairs manager, whatever it may be. So many different functions. In fact, this year we've cascaded targets to 8 different functions within the business, and that pretty much covers it all the way to solutions, to marketing. And now you start seeing how people incorporate these the thinking and the processes into their everyday work. So this is very important. I think, again, many companies are on different stages of that journey and how they think of it. Again, for us at ABI, because there is such a rigorous target setting cascading process that already exists, it's pretty simple to do it top down, and people understand their role within it and what that means. And of course, externally, collaboration, again, is very important because you can't take a siloed approach. You don't have all the answers. So how you work with some of the largest suppliers of the world, be it packaging, raw materials, as well as how you go and pursue the startups and the innovative solutions that are out there, which we're doing through our 100+ Accelerator program, because you're looking for the solutions across the entire spectrum of partners, because we can't do it alone. Yeah.
Okay, well, that's again very comprehensive, and if we could dig a little bit more, we might, because I think one of the questions of the organizations I meet is, how do I get the attention of my senior managers? Mm-hmm. And to set the target is one thing, to understand how it's going to impact the business, that's like a loop. It's an iterative process. Yeah. I'm sure you've been through many of those in constructing your 10-year plan. Yeah. Lindsay, why don't I ask you to give us a related view on this question, which I'll just briefly repeat. Focusing ESG efforts, and where has that involved crossing silos? You've already mentioned one in your introductory question. But
absolutely, maybe I can build on that.
Yeah.
Whilst also in the back of my mind trying to work out what the antonym of siloed is. Puzzling me now, but maybe it is integrated. Because I think if we look at our approach to ESG and think about where there are silos, if we're going to bust them, we need to think about where they are. It's really, organisationally, would tend to be around business units, not surprisingly, and you would see that in other asset management businesses. So, you'd have a public equities business investing in the equity markets, maybe a private markets business investing directly in companies, and business investing in fixed income, in bonds, in credit, effectively lending money to companies. And then we have a responsible investing team. So, we have a team, if we look across pension schemes in the UK, we have one of the larger teams with 7 people. But their responsibility, as I mentioned, has really grown up from really looking at governance issues, engagement, stewardship, voting, and they still have responsibility for all of that. But we're really then asking them to, for example, ensure that where we use third-party investment managers that we select and appoint, they are considering the financially material considerations, including the ESG factors, in their processes. And we have examples of where we've chosen not to engage a third-party asset manager for ESG reasons, so they weren't fulfilling what we needed. But then internally, as active owners, we have investment teams. We need to focus on sustainability and good corporate governance. And so the responsible investment team, coming back to the question, breaking down the silo is really getting them to work with the individual investment teams on building these factors into their investment decision making. So if I take an example of our global emerging market equities business, they will generally build detailed financial models of companies. They will engage with companies. They will talk to the management. But as they're building those financial models, their skill set typically would be particularly around governance. In emerging markets equities, that's often a key focus. But then the RI team will work with them to help them build in views on social issues, and indeed on climate. So they're providing that expertise and that support to the investment managers to help them with that. And similarly, if we look at our private markets business, again, very close involvement in the companies we invest in. Typically, we're taking large stakes in private companies. We will be perhaps even putting members of staff on the boards of those companies. But the responsible investment team have worked with them to ensure that they are fulfilling what's required in terms of our net zero ambition, that they're properly evaluating physical risk and transition risk in terms of climate, but also the broader range of societal and responsible investing issues that we look at. So I think we're seeing those break down across the organization, and I think the antonym is integrated because we're taking an integrated view of how we're delivering against our net zero ambition, how we're engaging with the companies that we invest in. So I think this sort of responsible investment approach that we've rolled out across the organization means that we really do consider the impact of the broad range of ESG factors on our investment decisions, and that's sort of regardless of the asset class, the market, or the structure. And I think it continues to develop. We're on a trajectory. I don't think it's all done. And as the person in charge of risk, I spend a lot of time looking at what we're doing and ensuring that it's fit for purpose and taking a sort of oversight perspective of that. But I think we're in a, we're moving ahead in terms of integrating those E, S, and G across the organisation.
And I'm not sure if Anna or Jimmy, you've already started us off on the antonym conversation, but Anna, you'd recognise a lot of these things that are being discussed. Perhaps you could give some examples from the industries you've seen, because I know you know a lot about mining, metals, and the construction and the like.
Sure thing. And actually, I think Jimmy's safety analogy at the top was well taken, right? And I'm selfishly saying that because it's one that I use with clients as well. If you think about safety 30 years ago, it was, you had the safety manager, and they were responsible for safety, and that's kind of it. And if you think about it now, with many of my heavy industrial clients, large-scale operations, there's a safety moment at the beginning of every meeting. It's part of everybody's job. It's baked into all of our processes. And we see ESG as needing to go through the same kind of a transition. And I think part of that is, how do you make this everybody's problem? Part of it is what Ezgi was describing around incentives. People respond to incentives. I think part of it is also around committee setup, exactly as Lindsay was describing. I'm also a big fan of having a carbon price and non-financial ESG metrics as part of the investment committee process. I think it drives good behavior and good debates within the top team. We also think about those kinds of trade-offs that once you go to IC, you could also think about how you set up your board. We counsel companies actually not to have a separate ESG and sustainability committee on the board, but to make this a core part of what every board member has to deal with. And so for us, this is about wiring the business to make this increasingly part of everybody's problem and part of everybody's job. I think you heard good examples from everybody on the panel.
Okay, great. So I'm going to move a little to a particular silo, which we're going to call the national versus the international silo. And everyone, I think, in the room is familiar with this. We all have activities, and it may be our upstream and our downstream, but it's often our offices and our markets are in multiple locations. So if we switch to that kind of question of national versus international and the silos there, and I'll ask Jimmy, perhaps you could open this by telling us about the evolution of standards and the tension or not between national and international.
Well, sure. It's after such an exciting round of responses to start talking about international standards, I think it is important, right? And hopefully it sets some context for where I think we're all trying to get to, and hopefully it does link into breaking these silos. Right?
Yeah.
So as I'm sure everyone's aware, there are two kind of sustainability standards approaches being developed at the moment concurrently. One through the European Commission, one through the IFRS Foundation's International Sustainability Standards Board. So huge, I guess, evolution from this Cambrian explosion of loads of different frameworks and approaches to measuring loads of different things in loads of interesting ways. We as a data provider, or as a sort of assessment provider, really want to see international standards proliferating and being used, so that we know that that's going to improve the amount of public disclosure that we use to create our assessments. And with that, the practice will improve. We're in this process now where the exposure drafts of the new standards have been out there in the market. They're being digested by the standard providers, and over the course of next year, we're going to start to see the first versions over at some point in 2023 of both of them. But there are two, right? So there are two different approaches. To some extent, there are some areas of difference. There are some kind of sequencing issues around phased implementations. So we're still going to be relying on the practices we have today for some time going forward. Yet, it's going to be really important that everyone who's involved in thinking about disclosure really presses on the need for interoperability, understanding that those really key matters need to be resolved around materiality, around other factors as well that each have their own kind of specificities that need to be addressed. And I think thinking about that, well, what does it mean internally? Well, you can also sort of add in other pieces that are coming out, like corporate sustainability due diligence legislation that's going to be affecting supply chains and reporting across supply and value chains. We need everything to join up, to be able to be understood, to be intelligent, to be intelligible. And that's where the standards come in. So there's great hope around the standards, and we can see some really good signals from both sets of parties to commit to working together, creating jurisdictional working groups. All of those things are really important, but I guess pushing forwards now and getting to that place where that really works is going to be so important. And I hope I've made standards super exciting for everyone for a moment.
We'll have now a view from a practitioner, a leader. It would be just interesting to hear about, and perhaps even the evolution, as it were, as you've realized, as we break these silos down, we're realizing that first we're being pushed to break them down, but second we're having to anticipate, which is kind of your point. So I'm just interested to hear how you actually manage that, given that, the country CEO is an important person, right?
Yeah. Absolutely. We believe in greater transparency and disclosure. So for us, yes, it's a process, and maybe not always an exciting process. But I do believe that reporting is not an end goal. It's a means to an end. And if greater transparency and disclosure externally and internally can give you that visibility to drive the right actions within the company, now we're on the right track. So I really hope that the harmonization of the standards are going to offer us the flexibility as well as the standardization needed so that we can tell our own unique story, the sector-specific geographic story as well. But ultimately, when you think of your materiality assessment, for a company like ABI, again, operations across nearly 50 countries around the world, we sell our products in over 100 markets. Materiality assessment is the point of entry. But now, increasingly, it's not just the materiality assessment in the sense that we've all known it, which is what is the outside-in factors on your business, the non-financial material risks to your business, but also what is the impact of your business out to the world. The double materiality concept is fast coming, and again, for sustainability for professionals like myself, that's a nice welcome, right? We want to be able to tell that story of what is our role in society, how does our company impact the environment and the society as well. So that's very important. And at ABI, we started with the voluntary frameworks that are out there, and of course we follow the local regulations. And yes, being headquartered in Belgium, we are closely following everything that's happening with the European Commission as well as the ISSB developments as well. And I think all of this, it's going to take some time. I don't think it's going to change fairly quickly. It will take some time. But if the companies are provided the right guidance of how to implement the right kind of phase-in approaches so that we can put in place the mechanisms and the processes, the internal controls, so that reporting disclosure becomes something that you can count on for years to come, that's really important. And I think increasingly what this is doing is it's also elevating the agenda to the board level, to the highest levels, right? And yes, we've been presenting to our board on supply security, on the broader ESG agenda, but now we're also engaging on transparency and disclosure, what that means, the different frameworks, the standards that are out there, the the growing number of requests that we're getting, the new frameworks like TCFD and now TNFD, the Task Force for Nature-Related Financial Disclosure. What does that mean for our business? All these, I think, create very important moments for us within the business to have the right conversation as well. So very much welcome, yeah.
Could I just ask you to comment on
Yeah.
a detail? How do you approach, and I know it's a moving feast, but
Yeah.
a normal issue people face is in this market, there are these standards, and some are greater and less transparency. Some require, it could be health and safety, it could relate to something like modern slavery, whatever it is.
Yeah.
But there are those different standards, and the easy approach, if you could manage it, would be essentially to declare from global headquarters
Right, yes.
that you're going to take the strictest standard in every market and apply it. But it doesn't quite work like that.
Yeah.
So I'd just like you to comment on how you manage that kind of patchwork, the
Yeah, I mean,
practicalities.
You
of
have
capitalism.
you have to let your local teams operate within the local context, whatever is required by the local regulations. But ultimately, you need to have a minimum set of standards that you're setting for yourself across the whole world. And it should not and cannot be the lowest common denominator, because then you're falling behind. And I think for us, again, we're fortunate that we're headquartered in Europe, because Europe has traditionally, set the pace
Yes.
for the development and the advancement of ESG agenda, and especially the reporting side of things. So if you can bring your entire company to those standards, which is what we try to do every year, we aim for that. And now with the latest developments, we're going to raise the bar even more. Then you'll be ready for the regulations that are soon to follow as well, and they will follow suit. You will see that, and we see that from around the world, and you now see it in Latin America, you see it in Asia, right? So it's not just a Europe and US thing anymore. Around the world, these regulations and standards are popping up, so you have to be prepared. Yeah.
And
Can I just...
I was just going to switch, in fact. Please go ahead.
Yeah, I was just going to throw in the investor perspective
Yeah.
on the standards and disclosure. Of course, the standards are useful and important from an investment perspective in terms of analysing the companies. I think 20 years ago I was working on equity analysis and spending lots of time reconciling accounting data between different standards and trying to sort of see through the disclosure and understand the story behind it. And I think that's still important. The disclosures are really important, the standards are really important, but of course as investors we continue to dig and understand the story behind that. I just throw in that the SASB, ISB checklist for different sectors are very useful for us as investors, and that's a helpful part of what we do.
Yes, I imagine the point at which you enter the conversation with the regulators and bodies is a little different to an individual organization. Now, I'm going to segue slightly, and I'll give Anna the microphone in a moment, but I guess we're interested really in the socialization of standards. So we've talked about, from the investor point of view, we talked about the business point of view, we talked about the standards themselves. If we talked about the kind of future of supervisory and regulatory action, and why don't I just point you in a particular direction? You've mentioned different metrics before, and it could be a health and safety side, but it could be non-financial metrics. So, if I ask you specifically how to manage climate change, let's think of TCFD, which seems to be relatively well-defined, and it seems to be trying to measure one thing, which is carbon dioxide. So it seems simple, even though it isn't. And then if you contrast that with ESG or even sustainability, it gets messy rather quickly. So I'd just be interested to hear your views on the kind of, as regulation evolves, how do we manage these metrics? And if we have time, we'll come to data as well. But let's carry on. Let's start here.
Yeah, sure. Happily, I am not in the business of policy advisory, so I will tell you how we counsel companies to think about managing through what appears as it is, which is a nascent set of ESG metrics and standards, right? So in contrast to financial reporting, where there's about a 99% correlation between credit scores from our friends at Moody's and those at S&P. Of course, Moody's is a superior product, but we have close alignment on financial metrics. We only see about a 54% correlation between the ESG scores of the 6 largest players. And we see that because when we choose to measure, for instance, employee value creation, you could measure that by saying, okay, I'm looking at how much you're going to spend in terms of training programs, Or you could look at it in terms of retention, or you could look at it in terms of number of hours provided in training, et cetera, right? So when we get down into the details, as your question points to, there's a lot of devilry. And so we counsel clients to think through actual intrinsics. You will not be distinctive on every element of ESG. You need to be very mindful of where are your superpowers, where can you as a business truly make a difference, and where is there materiality for you. For instance, if I'm an aluminum player, having a responsible sourcing strategy is critically important to preserving value, and where are my vulnerabilities? And be mindful of intrinsically actually what's driving that. And then we counsel clients to think through what are the 2 to 3 ratings agencies that you might work with that are measuring and monitoring those things in a way that aligns with how you see intrinsic impact against those metrics, right? Again, for us, it always goes back to fundamentals. Where are you intrinsically trying to drive a difference, and what are the ratings agencies that are supporting that? You will have more sophisticated thoughts than me on it, but that's how we think about it.
Well, why don't we just, Jimmy, yeah.
Definitely
Please.
not more sophisticated thoughts, but no, I think just to take that maybe a little bit further, for us, we, in the assessment and data provision work that we do, we rely on public disclosure. Yeah. But there is obviously a need for addressing private market SMEs and risks that are existing down throughout supply and value chains, and that's where we're looking to bridge the gap with modeled solutions as well. So those two things kind of can go hand in hand, where you've got a kind of more detailed assessment analysts with an overlay, sort of putting their inputs into it as well, but also that modeled layer on top. And I think probably another reason why this is important is, some of the work we've been doing is looking at data gaps and holes. So, gaps being areas where there isn't a process behind kind of measuring a particular indicator, and holes being, well, the process exists, but it's not frequently collected, and those kind of things. And when you sort of put those things together, you realize, well, we're just not at the stage where the data is available, so those modeled solutions are going to be important. But also supporting industry practice to say, well, hang on, this is a really important area, need to solve it, need to kind of get to an area. And Ezgi, you mentioned TNFD, and TNFD in their latest framework, the Task Force for Nature-Related Financial Disclosures, in their latest release of the framework, I hope I get this number right, but they mentioned there are over 300 indicators that companies are using in different ways to kind of to assess biodiversity risks and impacts. And that's their process to say, well, look, this is what we're going to do. We're going to create a process where we're not going to have 300. We're not going to be thinking about different ways. So if you're assessing, you're not looking at the different lenses by which you may think about a particular issue. This is how we're going to do it. And obviously it needs to be kind of sector-specific as well, to kind of make sure it has that ability to be comparable and relevant and useful.
Okay, we've covered a broad swathe of topics. There are one or two more, but I'm just going to jump because I want to go to a topic which I think we have to discuss, and we'll pick up some of the extra ones, hopefully, toward the end. We have, as I said, a kind of an outside-in view and an inside-out view, and we have an evolving landscape, and the waves, as it were, the uncertainties are bigger than most of us have ever seen, and they're not likely to get smaller. So there's now a question of where does the capability and capacity to recognize things come from? And so if I pose it as a simple, if you're an organization like USS or ABI, do you buy the expertise or do you build the expertise? And of course I know it's not one or the other, but I would just value some thoughts on how you go about doing this. And perhaps Lindsay, you can start, and then we'd love to hear from Ezgi, and then we'll switch and we'll hear observations from the providers.
Yeah, I mean, buy the expertise versus build the expertise. I guess the answer is probably both. If you look at the story I told about our responsible investment team growing up, adding more and more staff to that team, adding more and more expertise. One of our more recent hires was previously is a chartered financial analyst, so he's got all that expertise around analysing companies, and he's now working as part of the responsible investment team, helping bring their understanding of ESG and climate issues to bear on the investment teams and helping them get up to speed. So I think what we're also seeing is, when we do our learning needs analysis across the organisation, and we sit down as an executive committee, this comes, ESG issues, climate issues come up frequently. So, and we're seeing, growing numbers of providers out there. CFA I mentioned, some of the training providers providing more training to help us really get up the curve. In terms of when it comes to sort of buying versus building, in terms of the actual analysis, I think coming back to the sort of ratings that we were talking about, I think that if you compare credit ratings versus ESG ratings, yes, there's a much greater dispersion. And I think that what's useful really is to, when you get to the level of individual companies, looking at why different ratings disagree, looking at the frameworks they're using that to help get bring your knowledge along. Because I think, actually, even in the credit world, even if they agree, looking at the framework they're using, digging below and understanding, especially if you're making a large investment, is vitally important. And it's the same with the ESG rating. So I think we would look at ESG ratings, but we'd see, so we would buy, but we would seek to build our own understanding internally, particularly on the large.
If I could press you just a tiny little bit, would you say that you're shifting more towards, it's on a scale, but more towards the active side? So what I'm really asking is, when you're an owner or an asset manager, but you get to lift the hood, you get to look under the bonnet, right?
Yeah.
So are you giving those companies kind of direct advice on what sorts of things you're looking for, the kinds of information you're looking for, the reporting templates?
Yeah, I mean, we're very clear about what we're expecting in terms of disclosures. So, as part of our voting and stewardship activities, we're very active, and we will make clear our views on their quality and timeliness of reporting around their CSR, their carbon emissions, if they have fatalities, their human rights, child labour, modern slavery practices. So we are engaging on all of those things actively, for sure.
Okay, great. Thank you very much. Now you have you've already mentioned your security of supply, which you've mentioned that you go from end to end. Mm-hmm. So we could have this conversation about any part of the internal or external organization. But, perhaps if you could, I'll let you choose the area where you can enlighten us.
I would say we don't have the luxury of picking one anymore. Yeah. You can't wait to build internally, and you can't just rely on buying externally either, some of the ratings, frameworks, templates that are out there. Because increasingly what we're finding out is that our investors, our analysts, are looking for the context behind why you do what you do. So it's no longer enough just to put out numbers out there, which I know many companies are still in the process of tabulating and then putting year-over-year data out there, but that's just no longer enough. You have to provide the context of why you do what you do, what is important, what are the lessons learned, how are you going to get to that ambition that you set out, are you on track? These things, that the context increasingly really matters, which is not something easy to digest, right? Because for years we've tried to quantify ESG standards. There's still this outstanding question around, can we quantify it even more? Can we standardize it even more? Yes, and we have to also build on the qualitative assessments and the context that we provide to our internal and external audiences that are looking to be informed by the information that we put out there. So for me, it has to be both. And I think increasingly, if I'm looking at the capabilities inside a company, the most important thing is that you need to know the nuts and bolts of your business. The know-how of the supply chain and the business is so incredibly important. And I think, sometimes the companies think, okay, I can go get an ESG talent, or I can go get a consultant come in and tell me what to do. Unless you engage your internal operations teams, your commercial teams around your core business strategy, your core gaps, the key opportunities, you will not find an answer from an external person. Right. They can enlighten you, they can provide you additional kind of perspective maybe, but you need to really understand the nuts and bolts of your business.
Okay, and I think that's a familiar theme, but if I turn to either Jimmy or Anna, I guess I'd be interested to know, could you comment on trends in terms of the sophistication of the clients you're dealing with and the kinds of offerings, where you bridge gaps, if you like? Anna, do you want to?
Sure. I echo what both Ezgi and Lindsay have said around the need to both buy and build. I think the bar in this space is rising, as it is for every ESG and sustainability-related topic, right? We've gone past the point of needing to convince people that this matters, and we've gone past the point of needing to convince people you need to be reporting and tracking, et cetera. And so for us, I think this point around going under the hood that Lindsay was making, and that Jimmy was alluding to a moment ago, is critical, right? You need to have enough capability to actually interrogate what is driving the outcomes, what is your view on leading and lagging indicators, and I think to Ezgi's point, that has to be well understood within the business. We can come in and advise you on what metrics we think matter, but you need to understand where is true value creation coming from within your business. And so what heartens me with a lot of the clients that I'm seeing doing this well is that increasingly their sustainability reporting function and ESG reporting and tracking function is well integrated with the strategic planning team and with their financial teams, right? And so the person who is producing the best EBITDA bridge is also the person who understands very well what's going on with the ESG metrics that you care about, what's going on with your internal carbon price, what's going on with your sustainability commitments. And for us, those need to be increasingly interwoven.
Excellent, thank you.
Yeah, maybe just to pick up a little, just very briefly, investors in a broader sense are trying to do lots of different things with ESG information. So I think it's, some areas may be going very in depth on physical climate risk, on asset level data. They may be looking at things from a regulatory requirement point of view. So, there's lots of different reasons why our clients will be coming to us for increasingly more and more different approaches and different needs for the data. And so, absolutely. Echo what Lindsay was saying about having that dual approach of bring it in, adding your own expertise, doing what you're looking to achieve with it. I think maybe one other element to mention is thinking about what are you looking to from on that risk and versus impact scale as well, which is increasingly important and again coming back to standards is going to become a more important question going forward.
All right, so I think that was interesting, and I'm just going to highlight one point which SK has made in I think more than one way. I guess it's more and more up to the organization to tell their story to the stakeholders, of whom there are many, as we've heard, and some of it's financial and some of it's on the sort of more qualitative side. But I think that's just an interesting subtext, which you made very explicit. So thank you for that. Now, we've got about just under 5 minutes. We can have one little bite of the cherry of one of the topics which I haven't got to, which is, so I'll kind of throw this one open. So there's a notion of social fairness, of the just transition. And if I just mention two things which have come up in conversation between us before today. So if you live in the UK or Europe in particular, you'll know that winter is coming. With energy prices, and I won't say much about UK politics other than a sense of profound relief that our new Prime Minister has acknowledged that 50% of UK households probably wouldn't have been able to pay their energy bills. And it's doing something about it, so that's a huge relief. It's not going to solve the problem, but at least it has the national attention. On the other hand, if you look, this is very short term, right? It's almost parochial, a small energy crisis, quote unquote. If you look longer term, the waves of change are massive between now and 2100 around climate change and sustainability. So the transition there is it's almost unimaginable. Okay, this is not a small recession. This is a change of every one of our lives in every facet. So we have these two things going on, and the ordinary corporation and the shareholder value model is being challenged. None of us knows how far or how fast to go. So if I try to narrow that down a little bit, social fairness and the just transition is now a topic for corporate governance. And it could be these short-term issues, it could be the massive longer-term issue. So I guess I'm interested to know, first from Lindsay or Ezgi, can you give an example of how a business can or should square up to its, let's call it its broader social responsibilities? Because you have a commercial mission, right? So.
Yeah. Maybe I'll give two quick examples at the opposite ends of the value chain. So think of that smallholder farmer. They're growing barley. Barley is a crop that's grown in rotation. Usually the other crop that's grown it could be wheat, soy, alfalfa, it could, a food crop. how we think of that farmer level income, how we think of that yield gap or that productivity is going to impact field level, their farming practices. That means it's going to impact their social and economic well-being as well. So you're not only solving for environmental challenges around water use, fertilizer use, the carbon accounting that you're doing on the ground for that crop because of all the frameworks that are coming out, but also how you impact their socioeconomic well-being. On the opposite end, a small retailer, mom and pop shop, yes, we can work with them, and we're working with them in many countries to try and bring renewable electricity so that we can decarbonize our entire value chain towards our net zero ambition. But that renewable electricity is also lowering their electricity bill. So again, it's providing an economic benefit. So increasingly what you're seeing is that environmental, social, economic benefits or dimensions are so interlinked if you do this the right way, and if you, again, tell the story holistically. So we no longer have the luxury of solving for one thing. We have to continue to multi-solve.
Because effectively your value chain, you're linked, of course. Examples or thoughts?
Yeah, so a couple of examples. I mean, we do a lot, we're a small team in our responsible investment team. We have a lot of other asset owners that we work with. We talk about ourselves as universal owners. We're exposed to sort of the broader economy, and we group together with people like the Church of England's Pension Board, Hester, CBUS, Council of Ethics for Swedish National Pension Funds, lots of other pension funds to try and encourage change. So an example there would be working with a group to reach out to mining companies and other major companies operating in Australia to understand and seek assurances on Indigenous community rights. I think that was sort of triggered by incident in May 2020 with Rio Tinto and a 46,000-year-old site being damaged.
In Australia, which is my home country, so I'm aware of that one.
You'll be aware of that one. So seeking to, see change, and, we've got 76% of those companies have answered, and there are clear gaps. But then, we have also, on the sort of slightly different track, set up a sustainable growth mandate, so using our investment activity to really invest in the changes that will be happening going forward, and taking that longer term view. We just took a 50% stake in a big renewable solar voltaic plant or company in Spain and Portugal, and we're financing the building up of that to help with the renewables, which of course is both a sensible thing to do in terms of long-term energy, but also sensible for our members as well.
Okay. Now, I can't quite see the clock. I think we're past the witching hour, and apparently there are questions here. But I think just in the interest of time, I think we should leave the questions up, and perhaps you can approach us. So I think we'd better wrap the panel up. And I'd like to again thank, we have 4 marvelous organizations here who've actually shared their time with us. I'd like to extend my appreciation to Anna, Lindsay, Ezgi, and Jimmy. Thank you very much for your expertise and your input, and hopefully we can meet some people in the break. So thanks everyone.
Thanks, Danny.
Thank you, Danny.